Hello, everyone. On behalf of the Councils of Real Estate, welcome to this presentation of ESG, What on Earth is Happening? Thank you for joining us. I'm Anthony Delapelle, CRE, 2024 Global Chair of the Councils of Real Estate and Managing Shareholder at the law firm McCurdy Riskin, Olson & Delapelle in Northern New Jersey. The Councils of Real Estate is a distinguished international group of accomplished advisors addressing real estate challenges worldwide. Experienced, innovative, principled, and credentialed problem solvers, counselors reside in 22 countries, practice in many more, and offer expertise in 60 real estate disciplines across all asset classes. Each has earned the prestigious CRE designation. Let's recognize our 2024 sponsors: Busak Real Estate, Capright, Equus Capital Partners, J.P. Wigand and Sons, McCurdy Riskin Olson & Delapelle, Tristan Capital Partners, Relp, WPJ McCarthy and Company, and Barbara and Steve Leader, CRE Emeritus. Thank all of you for your support. Before we begin, I'd like to offer you a free digital subscription to the Counselor's peer-reviewed real estate professional journal, Real Estate Issues. It's been named one of the top 10 essential real estate publications in the U.S. Please visit cre.org/REI to subscribe. Today, you're encouraged to utilize the Q&A feature should you wish to submit a question. Your participation is welcomed, and we'll answer as many questions as time allows. Now I would like to introduce today's moderator, Deb Cloutier, CRE, President and Founder of RETech Advisors in McLean, Virginia, as well as the Chief Sustainability Officer for Legence, a Blackstone company. Deb's mission is to inspire and lead others to make sustainability a standard business practice by providing owners and investors of commercial real estate with intelligence to reduce operating costs, enhance asset value, and meet capital provider expectations. Deb was invited to membership in the Counselors in 2017, is a trustee of the CRE Foundation, and is the 2025 second vice chair of the Councils of Real Estate. Welcome, Deb.
Thanks, Tony. Thanks for such a warm welcome, too. I am thrilled to have so many folks on the webinar today and excited to share with you updates and insights on issues pertinent to ESG and commercial real estate. We're joined today by leaders of three of the most influential associations in our industry. I'll let them introduce themselves, their organization, and their roles. Sairah, would you go first, please?
Thank you, Deb. Thank you so much for having me join you guys today. I'm Sairah Burki. I am a managing director at the Commercial Real Estate Finance Council, CREPC. I run our regulatory affairs work and sustainability. We started our sustainability journey back in 2021, and we focus on advocacy in terms of working with the regulators, et cetera, education for our members, and transparency. A lot of work on identifying data that matters to our investor and lending members.
Thanks, Sairah. And Jessica?
Yeah, hi. My name is Jessica Long. I'm the Senior Vice President of Environmental Stewardship and Sustainability at Nareit. And Nareit is the worldwide representative voice for commercial real estate focused on U.S. REITs. And through my role here, I've been at Nareit for just over a year and a half, where I oversee our Real Estate Sustainability Council, comprised of our member REITs, heads of sustainability and leaders in that space. And I also work across the industry to advocate for REITs in various global frameworks and standards and regulations. So it's a pleasure to be here today.
Thanks, Jessica. Great to have you. And last but not least, Dave.
Well, good afternoon, everybody. And again, thank the Councils of Real Estate for inviting all of us to participate in this interesting panel. My name is Dave Borsos. I'm a Vice President of Capital Markets and Student Housing at National Multifamily Housing Council. NMHC is a trade organization that the primary goal is to represent owners in the multifamily apartment industry. We don't cover any of the other asset classes other than that. So everything I'm going to talk about today is going to be in reference to that particular industry. My responsibility here is to cover anything related to capital formation, which includes a lot of finance pertaining to resiliency and sustainability, and also represent the firm in anything related to capital formation at all, whether it's regulatory or legislative matters. Thanks for inviting me to be on this today.
Great, thanks so much. Well, as the folks attending today can see, we have some of the foremost experts with insights to share. So we will endeavor to answer questions, as Tony said, in real time throughout the session. So please don't be shy. Put your question into the chat window for us or the Q&A window, and we will endeavor to answer them as we go along. I feel compelled, though, to start today's fireside chat acknowledging the devastating impact that the recent hurricanes are having on the southeast coast of the U.S. Hurricane Helene was only 2 weeks ago, wreaking havoc and costing lives, property damage, and infrastructure disruptions, followed last night and this morning by Hurricane Milton, pummeling the west and east coasts of Florida with intense rain, high winds, storm surge, and over 60 tornadoes. It will be a while before we know the full extent of life and property damage, and our hearts and prayers go out to those affected by these events. Last year, we know that climate-related insurance claims exceeded $110 billion, and around the world, a weather-related event that costs in excess of $1 billion in property insurance claims occurs every 18 days. So let me set the stage with a few observations to kick off our panel today. The U.S. campaign trail has both candidates taking dramatically different approaches to support the transition to a low carbon economy, or what many are calling the energy transition. There's a rising demand for energy due to the growth of generative AI, further constrained by the continued aging of our energy grid and other infrastructure systems. Insurance costs are increasing by double and triple digits, and in some areas, there is a growing lack of insurability. All the while, consumers are demanding more healthy choices, and tenants and occupants are looking for solutions to both reduce costs and bring back their tenants with more amenities, often focused on enhancing well-being, productivity, and safety. It's safe to say that the regulatory landscape and the emerging reporting standards continue to proliferate, albeit more aggressively in Europe and Asia than in the US. If you would, Shay, please put up the map of the US. This is a map from the Institute for Market Transformation, and it shows the types and locations of more than 36 laws and ordinances across the US. And now Shay has the map up of the ESG related regulations sort of globally. So we can take those down now and maybe just go back to the presenters' faces. The last thing I wanted to sort of set the stage with is that institutional investors and shareholder demands are increasing for transparency, resilience, and decarbonization, all linked to asset and fund managers' ability to raise capital. But there is a stark dichotomy of who cares and who's focusing on this in the industry. So we've seen a dramatic shift by real estate organizations committing to decarbonize their real assets, and then more recently, many who are quietly backing away from ESG and impact investing. So my first question I'd like to start with you, Jessica, is the ESG party over? What are you seeing, and what are your members sharing with you?
Yeah, thanks, Deb, and thanks for that context to really set the scene and help lead the conversation. It's really interesting to see how the discussion around sustainability, energy, climate, social issues have evolved over the recent years. So say really over the past decade is what I'll focus on. And it's really, started before that with the idea that you can't manage what you don't measure, is at the core of what has now become known as ESG. And depending on where you sit in the real estate capital stack or in the global financial system, your approach to managing non-financial risk and your ability to quantify and influence that performance is really very different. And so kind of bringing it back to something that starting with, it would be more familiar to folks, or maybe more familiar to folks, is starting with the G, the governance. And it's widely understood that how companies are governed, strong controls over operating practices and financial decision-making is monitored and measured. And we have regulations such as SOX that everyone is familiar with, covering kind of corporate governance, risk management, auditing, financial reporting, and those kinds of things. So when you think about the context of the financial system, and then now you overlay environmental and social issues, we see that ESG really the impetus for wanting to bring those things together and to say, okay, well, this make governance as a non-financial factor that may influence the performance of a company. Now let's layer in environmental and social challenges within this same framework. So going back to 2015, the Financial Stability Board founded the Task Force for Climate-Related Financial Disclosures, known as TCFD, really recognizing that the standardization of data is necessary to inform efficient capital allocation and decision-making around climate-related risks. So if you can believe, it's only been 7 years since TCFD recommendations were published in 2017. And since then, we've seen such an explosion of the way that climate-related risks are disclosed and absorbed into the financial markets. And so the sophistication of the reporting and disclosures has then now turned into greater absorption of that data into the financial markets, to where now you have companies and investors that have kind of baked that into their own disclosures, investment processes, and the way that they look at companies and evaluate company performance. So all that to say, there's really no going back. We really now know so much more about the ways at which climate and social issues impact financial performance. So disclosures around climate, human capital, impacts to nature are really material to the investment process for a lot of global investors and public companies. And then again, especially in real estate, in private sectors, specifically real estate that relies on large institutional capital. So stopping disclosing that information or not focusing on that really would not be reasonable or make sense. It would significantly impact how an investor would look at that company. And we've heard directly from real estate investors lately that the cost for a building to decarbonize, potential losses from natural disasters are crucial information for them to assess risk. And again, more tools are becoming available, and more sophisticated disclosure and dialogue between companies and investors are really moving that conversation along. On the regulatory side, a lot of the regulation, the ESG regulation that you see, is really a pushback on the misuse of this data. So really anti-greenwashing and looking at how to make this process work better in the way that it is meant to work. And so you'll see where some of the claims that maybe environmental and social issues are more prominent in the investment process than they really are. And you're seeing companies getting called out for that. And similarly, you're seeing pushback against ESG on the other side when it's seen as going too far and interfering with that fair market, really allowing investors to take the data and make an informed decision. And so I think kind of based on the current regulatory and market conditions, it would be very hard for a company, especially within real estate, to say there are no environmental and social factors that are financially material to their business. I think that, there'd be a lot of questions about how they made that decision. And so again, with where things are, even if you were saying that, you would probably need to have some backup to how you arrived at that. And that would likely involve some data and some metrics. So kind of going back to your question, is the ESG party over? I'd say Definitely not maybe move to a new location. It might be drinks at the bar after the party or the meeting after the meeting. But it's far from over. We're moving into a space where sustainability and social responsibility issues are really being considered side by side as part of financial performance. And more data and sophisticated analysis will continue to come. I know we're going to go into a lot more detail of what those risks and opportunities are around regulation and insurance. But we definitely see that now we have a broader group of industry stakeholders participating in the conversation. We have legal, accounting, brokerage, professionals that are getting involved and asking more questions and trying to understand how sustainability and ESG is playing a part in everyone's day to day.
Yeah, no, thank you for that. I think that was a really great overview. And you know, I think a couple of thoughts just to pull on and pass it over to David next, which is Jessica talked about materiality. She talked about not everybody is focused on these topics in the same way. Many organizations are starting to collect data, whether they want to or not, and disclose that. So can you share with us a little bit of your perspectives in the multifamily industry and your members in terms of, you know, how they're feeling about ESG, and is it really ESG that they're focused on? And maybe lead us right into our next topic also about what laws, existing laws and regulation is your organization helping members to understand and sort of prepare for? So you want to take that? It's kind of a two-parter there,
Yeah,
Dave.
absolutely. I think it's important to get a context of the variety of members. So all three of us actually work across trade organizations. We oftentimes work together on regulatory issues. We have drafted comment letters. We've signed on to coalition. So oftentimes the power of multiple voices is certainly important. For instance, on the SEC climate disclosure rules, we all work very closely on that together, and our names are all jointly signed on comment letters and work very closely on that. One of the things that's important and very different from our trade organization, from the multifamily industry, is we don't have the preponderance of our members are not publicly traded. And so when they're smaller, they're not as well capitalized. We have plenty that are well capitalized, but there's a wide variety of that across the industry. I think there's 22 million units of apartments across the United States. Within that, the ownership is all over the place. Over 50% of those buildings are under 50 units, which is a pretty small property. Oftentimes when you get under 20 units, and there's a lot of those as well, not professionally managed, not deeply capitalized, et cetera. So there's a cohort there that serve a lot of the population that may be impacted by regulation, but don't have the internal resources, the reporting capabilities, et cetera. So once you go to those larger ones, a lot of the things that Jessica was talking about are very pertinent to some of the larger organizations. Why? They raise capital internationally. And so while we in the United States are, and I would agree with Jessica, it's not going away, but a lot of her members that are publicly traded REITs are always at the forefront of that. Some of our members who are members of hers have been doing this for a long time. And others are being asked as they raise institutional capital to think about how do you capture it, how do you report on it, and that framework is as we all know comes from a lot of different directions. And so the part of that is driven by the investor community, and on the regulatory side, which I also mentioned already, the SEC is doing some of that, but also as it pertains to the sustainability aspect of it, there's been a lot of recent rules that are going to talk about appliance efficiency and what are the costs to do that, and time frames to do those types of things. And that's at a federal level, but there's a lot of things going on at local level. Within New York City, some of the building energy requirements, or in California, are driving costs for our members. So from an energy perspective, clearly a big focus. a lot of the components of ESG. And when I talk to my members, whether they are reporting in that framework, the bottom line is to kind of reinforce what Jessica said. This is good business. I'm already doing this, and so yeah, I may have to report on this, but this is how I do business anyway. It would be it wouldn't be right for me not to be focusing on these issues.
Yeah, and I
And
think
am.
oh, just really quick, Sairah, I was going to say, just to lead into you, I think the idea of sustainability growing up as a like a actual focus area for business and making it more about risk management is where we're going to see continual steps towards embedding it as standard business practice and less of a bolt-on. And so Sairah is going to throw it over to you and get your perspectives from CREFC and your members around this data and sort of, is it a nice to have, and how legitimized is it? You know, just speak to us a little bit about CREFC's position on, is our party over?
Yeah, no, absolutely. Thank you. And I completely agree with everything that Jess and David walked through. I think, you know, here in DC, maybe we're more exposed to it, but there's so much rhetoric on the Hill. And I think that's kind of part of is the party over question, a lot of the kind of messaging. You know, I think the House Financial Services Committee in the House just passed a lot of anti-ESG bills. So there's just a lot of noise I think you have to cut through, but I think you're exactly right. I think from the perspective of our members, it really isn't about like sustainability or ESG. It really is about good business practice, risk management. I think Dave mentioned, like, we've been doing this all along. Like, our investors and lenders, they want to have assurances that the properties or the, you know, bonds backed by the properties that they're investing in or lending against are resilient. You know, they want to make sure they have mitigants in place to the extent possible. And, you know, I think we're seeing a lot more focus on the resilience side, just because it's easier to understand. And from, I think, a business case, it's easier to understand, you know, the savings you will accrue as, you know, if you're, you know, bolstering against potential climate events. I think on the energy efficiency side, that feels a little less tangible, I think, to some members. I will say that some of the larger institutional investors, though, are very focused on that. I think a significant reason is that they don't want to invest in assets which will, a few years down the road, be considered stranded assets, assets that are not sort of up to, you know, business standards, not up to par, and then, you know, potentially losing the interest of, you know, a high quality tenant. So you have the stranded asset question, and then you have the, you know, resiliency question. And I think, you know, you had mentioned data. We're very, very focused on data, you know, and working with our members. It certainly has become extremely clear that having the ability to understand what is important in terms of sort of the climate related data. And I'll just back up for a second, in the sense that what our membership is most focused on really is sort of the E and ESG at this juncture, both sort of you know, the impact of climate on your properties in terms of resilience, and in terms of, you know, emissions and energy efficiency, although I did mention that's a little bit less black and white. But what we do here is that from the broad range of market participants is that we really do need consistent and reliable data. I know that's what the SEC kind of indicated they were trying to achieve with their disclosure requirements, although that's obviously hung up in court for a while. But, you know, we know borrowers want to be able to clearly share any progress they're making, both in terms of efficiency measures and resiliency measures. And, you know, and from CREFC's membership perspective, lenders certainly want to see disclosure, you know, that they can trust, that they know they can trust, and that they find useful. And obviously, and I know Jessica talked about this, but in the backdrop of all this is really sort of this continued angst regarding potential greenwashing. So that is something that is certainly top of mind for, lenders and investors. But I think with data that's like higher quality and more standardized, we'll, eventually see more private capital coming in to like sort of the greener or more resilient product, and hopefully see more liquidity in the space. There's a lot of discussion around greeniums, et cetera. I think there's a lot of that, more of that in Europe abroad. I don't think we have seen that in the US. And quite frankly, I'm not sure we'll ever really see that. I think the benefit, just a purely financial benefit of having some of these greener properties, really is that you're attracting a broader investment base and potentially a stickier investment base. So the investors might be more willing to kind of stick with you even in market downturns. So I think that's something really important to keep in mind. And Deb, I can talk more through maybe later in terms of the details around some of the data that our members really want to see from the issuers and borrowers, but I will turn it back to you now.
Yeah, no, let's hold the thought on that because I'd like to circle back to it. But while you covered many things there, I'm going to try to pull together a couple of threads. One is consistency of information and the ability to feel confidence in it. Another thing that we talked about there a little bit was the motivations. Some investors, owners, developers are motivated by reducing costs. And that I think was in the earlier days of energy efficiency and adoption by public-private partnerships spurred on by like Energy Star or Department of Energy's Better Buildings Initiative, and organizations recognizing that strategic energy management is an effective business practice and can control costs. But now we've really had quite a turnaround in terms of the motivation that's been spurred by local legislation, laws, and disclosures. And so turning maybe to building performance standards, which are cropping up around the United States. Most noteworthy would be areas like Washington, D.C. and New York City, all the way over to the other coast of Seattle and California, and throughout in Denver. These are regulations that set emissions caps or performance caps for buildings, meaning that if your building is the energy that it's using to operate results in emissions that are above a threshold, that building, that owner will be incurring fines. And so that's driven a real change in the motivation to look at the cost of inaction and the potential time value of money of, well, if I now have a dollar value associated with a fine in the future, if I know my building is above a certain threshold for emissions, then I could use that money today to make investments that has a different, financial return to it. So I'd like to maybe turn back to you, Jessica, to ask, what are you seeing in terms of existing regulations that you're preparing your members for or helping them to be aware of? And maybe what are some new actions that they're taking that they didn't before? Because, well, let's just say there's a stick now and a little bit, more than just a carrot that's out there to drive action. And then I'm going to come right back to you shortly, short answer. And then David, back to you in terms of like, what's that mean for multifamily? Because it's kind of a different scene. And maybe what programs or incentives are out there that are helping folks. So a little bit there, take it where you'd like, Jess.
Yeah, thanks, Deb. And I think this is one of the main issues, and real estate has really been kind of a key area of focus for green legislation through these local building standards. And as a reminder, kind of this started back in 2017 when the first Trump administration pulled the US out of the Paris Agreement, and local jurisdictions started kind of saying, we're still focused on this. And so you saw New York, DC, the state of Washington being some of those first movers in this space. And now we've gone through that process. And so again, we've got large commercial building owners that own buildings in these jurisdictions have now kind of gone through the process a few times and learned a lot of lessons about what works, what doesn't, how to engage with lawmakers And we see an uptake of in local jurisdictions looking at these laws to achieve their own climate goals. And so when you look at the carbon footprint of a city or a state or county, the buildings are a huge part of that carbon footprint. And the local jurisdiction is typically the regulator of those buildings. So you're paying your property taxes. They are issuing permits for and doing zoning. And so real estate owners have always kind of had a close connection with local government through in that way. And so what we see is now the ability for the real estate community has become much more sophisticated in understanding these laws. And recognizing kind of what makes good policy that actually puts building owners and the regulators kind of working together towards that common goal of decarbonizing. And I'd say one of my experience kind of as a real estate professional in some of these discussions has really been to educate the local government on what is happening in the capital markets. And this is the way that we are already kind of working on this and really assuring them that the real estate community is here to partner with the local jurisdictions to move the discussion forward. And we're on the front lines of climate together on both sides, on the physical and the decarbonization side.
Yeah, having a seat at the table as a real estate practitioner is really important to help influence the outcome. I put in the chat a link to a very brand new publication that just came out from the Real Estate Roundtable. It's a policy guide on lessons learned to shape fair and reasonable building performance standards. But Dave, can you talk to us a little bit about what's happening in the multifamily space, and is there money available to help some of these owners?
So I'm going to build a little bit on what Jessica talked about from a regulatory perspective and the kind of mentioning the presidential election, which you didn't really, it's actually could take two very divergent perspectives depending on what happens in November, right? So we have kind of already got a little bit of insight, to be honest with you, either way, what happens depending on whether Republicans win back the White House or whether it's the Democrats. And so this is going to be pretty important in terms of at a federal level what's happening. And again, going back to what Jessica said, a lot of the state level regulatory bodies have said we're going to continue to do this. It doesn't matter which, what's happening here in Washington, D.C. With that in mind, I'll talk a little bit about some of the local stuff in terms of what's happening. And we mentioned already New York and California, and sometimes this results in people making a choice to walk away. And I've certainly had those conversations with some of my members, and one of them is actually is a member of Jessica's as well. We've had a lot of conversation, and they're like, some of these things in New York City are just incredibly unreasonable from a timeline and what the cost is. And at the same time, affordability is a big focus in the multifamily industry. There's a lot of pushback in our industry right now regarding affordability, but when you have costs being driven by regulatory actions or whether it's climate related, et cetera, there's a lot of those things that are driving the cost to operate. And so the industry is very focused. And again, a lot of the things I would talk about, whether it's tax credits that came from the bill passed by the current administration that put an awful lot of money through tax credits and other types of investments within resiliency and sustainability. Is a lot of my members are taking advantage of that. HUD has a program, GRRP, which again, depending on whether you're a HUD finance property, are another way for people to access money. And again, this is the E side of what people are doing. We're kind of talking, kind of across the board, but these are programs where there was a significant amount of money provided by the federal government for retrofitting. And the one thing I want to make sure that it's important for people when we did the word cloud, when we first started here, and when we were doing a prep call, we oftentimes are using sustainability and resiliency interchangeable. And given what's going on in Florida, I want to make sure that that people keep in mind, a lot of those programs that I just mentioned are very sustainably focused, right? Not all of them, because some of them are resiliency focused, and one of them says, can you sustain the type of storms that are going on right now? And those are challenges, and it's important for us to think about that when we're talking about investment here, right? You may get a more immediate impact to your NOI from a sustainability focused investment, and a little less immediately on a resiliency side, other than when you go through the types of climate events that we're going through today. And so there are a lot of programs. For instance, this afternoon I will be joining, because I'm a member of Fannie Mae's Green Task Force, and that's, green financing. And so they have a program that's been around since 2010. And there's, but both Fannie Mae and Freddie Mac have well-developed programs where they're issuing not only impact bonds, they're issuing green bonds, social bonds. So they're very focused on an investor sector that is also interested in supporting and investing any one of those components of ESG. So, here's the two largest providers of finance in the multifamily industry through their regulatory agency are focused on these particular issues, but it's one has spanned across both a Democratic and a Republican administration, and it's something that they continue to focus on and have very well-developed programs. So, if people are looking for financing avenues, that's certainly two mechanisms in which have gained a lot of credibility in issuance of their securities.
Yeah, no, thanks for that. And, open to any of the panelists, I'm just going to pull in one of the questions from the chat. If we could just quickly touch on how do these mindsets, legislations, and actions compare to other markets globally? Where is the US relative to the UK, EU, Canada, or APAC? I think any one of you could jump in on that one.
I can take the first crack at it, just because we're always getting questions from membership on direction, at least at the federal level, kind of trying to game out a Harris win versus a Trump win, and then the composition of Congress. But I would say, as I mentioned earlier, like the anti-ESG sentiment has really, I think, has taken hold in several different sort of parts of the government. Mentioned that the SEC's disclosure rules are hung up in court. I think, and I don't mean to get like super nerdy here on the legal front, but with the Supreme Court's overruling of the Chevron deference earlier this year, which basically upended, 40 years or so of administrative law where courts would defer to regulatory agencies' interpretation of statutes that were considered unclear, ambiguous. This sort of clawed that back to the courts. I think there's going to be a lot of uncertainty moving forward, regardless of what administration is in power, because any type of federal regulation, and certainly I think this will be very, very pertinent to sustainability and ESG. I think any regulation related to those words will end up in court. If there's a Republican administration, absolutely. I think, or overturned by a Congressional Review Act, if that's on the table. And even under Democratic administration, you could see sort of the reverse. So you could see an attempt to maybe undo some things that Republicans have tried to do. I think a lot of uncertainty. And then, in terms of the EU perspective, I think, there's, I don't want to say the regulation is clear, but the direction is very clear. And I think one of my co-panelists mentioned it earlier, from our membership, when they're getting inbounds from European investors, there's certainly a lot more information being requested on the sustainability front. They really need that information, and they need it for regulation. They don't just need it because from an investor perspective, it makes sense to understand those pieces of data, which they do, but they absolutely need it because under the regulatory regime over in Europe, they need to be able to report that. And it does trickle down, and it does pull in some US companies that have subsidiaries over in Europe. But I just think it's more clear in Europe. I think it's difficult for folks to understand how to implement some of the regulations in Europe, but it's clear that they're going to need to have to figure it out. Whereas here in the US, it's a lot of like how to push and pull. Then as Dave said, it continues to move forward at the local level.
So I think, look, I agree with what Sairah just said. I think if those who are internationally who are on this call and kind of trying to understand what's going on in the United States, I think the EU is in fact much more uniform in their approach at a national level and then combined between all of those countries. Whereas I think we've already talked about this. I think what you're going to see going forward in the United States is a patchwork. You're going to have individual states who are going to be passing rules and regulations regarding that because it may or may not be coming down from the at a federal level. And I do think, and again, getting nerdy because we talked about this we just had our student housing conference this week, and we talked specifically about the Chevron ruling. There's going to be a lot more pushback on the federal agencies who have mandates over a particular, whether it's FHFA, whether it's SEC. There's going to be a lot more pushback within the courts to say, we don't think that the statute you're operating under allows you to promulgate the rule that you're putting out there. So I do think we're going to get a lot more pushback at a federal level, regardless of who's in office. And it's going to be much more of, you're going to have to understand as an investor in the United States, which local jurisdictions are mandating rules and regulations. And much like I talked about earlier, I have some of my members who are going to make choices to either invest or not invest in particular jurisdictions that may have rules that they may view as unfavorable.
Right. And so I'm just doing a time check. We have just less than 20 minutes left. We have two more topics that we want to hopefully get through. Let's turn to our next topic, which is about risk. And specifically, let's talk a little bit about insurance too in this one. And I'd like to just draw the audience's attention to a prior counselor's webinar that took place in April of this year on insurance. And I really encourage folks to listen to it. It's available on the website. Very insightful updates on alternative risk transfer, looking at how financing strategies are evolving and being explored to minimize costs and safeguard capital expenditure reserves. So we won't get into the nerdy details of what's happening with insurance right now, but maybe let's start with you, Sairah. We'll share a little bit about the findings from CREFC's ESG risk report and maybe highlight, some things related to insurance for us.
Yeah, absolutely. Thank you. I think it's no surprise that, within our sustainability work, insurance is probably the most important thing, along with sort of data transparency that we're working on. Deb mentioned a report we do semi-annually with Oxford Analytica on ESG trends and CRE finance. And, we talk about insurance a lot within that report. A few data points to look at. We point to Harvard's Joint Center for Housing Studies. They do a lot of analyses on insurance, on the insurance market in the US. And they find that more than 18 million rental units in the US, which is about 40% of the total stock, are threatened by extreme weather events and increasingly uninsurable, particularly in California and Florida. Although I think we have to note that other states are certainly seeing also very sharp increases in property insurance rates. I think we trying to do a little bit of a deep dive into some of the insurance issues, and it's consistently changing. And we had thought that this year would see some moderation, and I think the first half of this year certainly did see some moderation in terms of the rise in insurance costs. But I think some of that will certainly, unfortunately, in the wake of these hurricanes, the moderation probably out the window. Historically, property insurance expenses grew by like 2 to 3% per year, but more recently it's been 20% in some markets. And there is a Moody's report, which I cannot find the link to. It's a PDF, but maybe I can circulate it later, which I highly recommend. They do a great study on insurance, specifically on CRE, and they found that CRE properties had seen about almost a 10% annual growth rate in insurance costs since 2017, with multifamily being impacted most acutely. And this kind of going back to understanding the different risks to properties and the impact on overall kind of financial health. Yardi Matrix had a report out which indicated that insurance costs now account for 8% of operating expenses, which is twice as high as just a few years ago. And that might seem like a small number, but when it's doubling, it's pretty significant. And, folks are seeing deals fall through sort of at the last minute once insurance costs are kind of considered into the full calculation. Everyone's asking, I mean, it seems quite obvious that a lot of it is related to, climate events, et cetera. Although the Moody's report, again, very, very interesting, kind of dives into why that relationship is not necessarily 100% clear. There are a lot of drivers of insurance expenses, including social inflation. So a lot of litigation, for example, in Florida, general inflation, and then of course, these climate events. And certainly of the climate events, they're through the research, they're seeing hurricanes specifically seem to have the biggest impact on insurance rates. But I think there's a lot to do, obviously a lot to do in terms of solutions. I know, Dave and Jess and a lot of other trade associations have been working to try to identify potential solutions. There's not one size fits all type of solution, but is there sort of like a terrorism risk insurance type, climate risk insurance type government backstop and that sort of thing. But given the political environment at the federal level, of course, I think it'll be difficult to pass through something sort of far-ranging. But I think just want to quickly touch on flood insurance, because that's certainly going to and has been in the headlines, will continue to be in the headlines. With the 1-2 punch of Helene and Milton. It looks like NFIP, the National Flood Insurance Program, will pretty much be depleted. They can borrow up to, I think, another 10 billion or so from Treasury. I think there's a lot of concern that we're going to pass that in terms of needs. We'll probably see Congress try to pass, through the Small Business Administration, a disaster recovery plan. But, this is something we absolutely have to solve. FEMA insures about 4.5 million properties across the US where they've designated flood zones. And, private insurers don't typically provide flood coverage, but I think they're two very obvious problems. One is the funds being certainly completely drained, and having to look at other mechanisms to raise money for folks who have lost and damaged properties. But another interesting thing that was highlighted by Helene was that in a lot of places where there is so much flooding, but it's not your typical coastal or riverine flooding, but flooding induced by rainfall. Those weren't even FEMA designated flood zones, and those folks didn't have any flood insurance. So that's a very significant problem. And the NFIP, I think, stating the obvious, and there's a lot of people calling for reform, but it's been a really difficult task to implement. So we'll see what happens moving forward, but it's definitely something to keep an eye on.
Yeah, I'd love to hear, Dave and Jessica, your perspectives from your members on maybe just some new approaches that they're taking to address risk. It could be insurance or otherwise, just understanding that there's such a misalignment in that time horizon, right? You purchase a building, you have a pro forma, you have your capital reserves, you have expectations about your terminal exit value, and then your costs go up in a way that you did not predict. when you first did all that, all that math. So what are you seeing your members doing, or what are you helping them to how to think about these things? Dave, maybe start with you.
Yeah, sure. The federal programs that Sairah mentioned are controversial. The flood insurance program keeps just getting reapproved and for brief periods of time, and because there's a lot of controversy at a federal level to support that. And yes, we have worked a lot with Congress as insurance has become a major issue. They're probably unwilling to take on another type of insurance program, and so it is something that there's potentially a role for the government to play in, but I think in the meantime, there's other things that people are doing. Some of my members are doing self-insurance, or doing their own captives, which, look, let's be realistic. That sounds great as long as you don't have a catastrophic event, right? So you're self-funding, and if things, let's call it, go as normal, and you have certain things that occur, then you can handle that. But to the degree that you have something like this, and I'll give you an example with the approach of the hurricane that was just coming. I literally got back from our student housing conference last night, and one of my conversations with a member said, I have 10 properties that are, in that Tampa area around University of South Florida and Central Florida. I don't know if they're self-insured, but that's clearly to the degree that you would have something like that. A captive doesn't necessarily have the financial capability to cover that. So even if you can go out and buy some other type of reinsurance, which is another challenge, right? And whether the reinsurers want to participate. So there are lots of things that we are having discussions on, none of which, I hate saying, are easy for government to play a role in. And the focus, I think, in the short run, I hate saying it, we're losing the battle on sustainability, on climate change right now. And in the meantime, we have a lot of buildings, we have a lot of properties and locations. Resiliency has to be a focus now. And those are the things that we can spend some of the money on to do things now, so that the catastrophic nature of houses that are in those zones or whatever else can withstand more of those climate events. And so I think that's where people are, in the short run, going to be focusing some of their direction. There are others who just simply can't get it.
Yeah, and just in the interest of time, do you mind if I jump to our last topic? And we had just a couple questions come in.
Yep.
Forgive me, I'm going to take moderator privilege here. So just in the time that we have left, let's go to our final topic today, which is really around finance. We did have a question come in around CPACE, and is that something that you're helping your members understand is an option? So if you could maybe try and answer that one too while we're in this. But what should our audience know about this movement to really reduce the asymmetry of information in markets? And can sustainability data be tied in with financial reporting? If so, how and why? Like, just, maybe give us a start on that one, Sairah. Short answer, and then we'll turn it over. I'd love to get Nareit's perspective on this.
Yeah, absolutely. Yeah, so this is a very key focus for our members. We have been working over the past couple of years to try to identify some key fields that our lenders and investors, need as they're continuing to do more due diligence on the climate side. We have probably like 8 or 9 key buckets of data. Like regional climate risk, resiliency certifications, green building certifications, benchmarking standards, Energy Star, energy savings measures, nothing all that shocking. I want to keep this really short, but I do want to mention that a very exciting development is that the ASTM, standards organization, they have finally approved the basically their standard for resiliency. So property resiliency assessments, I think, is going to be extremely helpful moving forward, because as we've been discussing this, entire call, a lot of need for information on resilience, understanding how hazards are identified and potential mitigants are developed. is very important, and the lending and investing communities, wants to have some comfort that there's standardization around that. So if there's an ASTM process that's been passed on understanding the resilience of specific properties, I think that's almost game changing moving forward. Not to be overly excited about it, but I will end with that. So Jess has some time to talk.
Thank you,
Yeah,
Sairah.
no, I'm really excited about it as well. I got that news yesterday myself, and it kind of dovetails nicely into what I was going to say, which is really having that common understanding. And we've said consistency of data several times during this webinar, but a lot of the rhetoric has really clouded the understanding of what's happening in the market. And so I'll reiterate something that was said earlier about the European regulation really trickling down to companies across the globe. It feels like we've been crying wolf maybe for a while that like this is happening, but it is indeed happening. A lot of the regulations take time to implement, and again, take time to kind of filter through, but we're hearing more and more that is coming, and that decision making will be more informed directly by sustainability related data. And I think that's really important to as a takeaway from this webinar. And without that consistent data, you are kind of moving to that lowest common denominator where you can get data consistently, and that may not be a true reflection of the opportunity and risk for a specific company. Again, for REITs based on their underlying assets. And so I always think about REITs as far as the company, and then the underlying assets, and there's regulation and impacts that are happening at different levels for those groups. To answer the question about pace and thinking about the tools that are available, as we better understand the cost to make a building energy efficient and meet those climate goals and make a building more resilient, REITs and commercial real estate companies are going to be looking more closely at different financial tools and how they might look at their capital stack a little differently to finance those projects that really will need to kind of move forward in the short term.
Yeah, I think we could have an entire webinar just on what are the various financing vehicles that people are using today, spanning from green bonds to here in the United States, we have a number of incentives coming out of the Inflation Reduction Act, the Infrastructure Act. In Europe, there are loads of interesting new financing vehicles that we're seeing our clients to use. But with that, we will leave you wanting more. And we will say thank you very much to Nareit, NMHC, and CREFC, and our representatives today for sharing their insights. Thank you all very much, and I hope you enjoyed the conversation. And back to you, Tony.
Thanks so much, Deb. And thanks to David, Sairah, and Jessica, our presenters, for helping to make the application of sustainability measures a standard business practice among your clients, constituents, members, and colleagues. It's obviously a very important issue and one that ranked in Councils of Real Estate's 2025 top 10 issues affecting real estate. Impacts all of us. With that in mind, especially today, we wish our members, our guests, friends, family, clients in Florida and the rest of the Southeast all the best in dealing with the impacts of the recent storms there. Please join us as our fall series of webinars continues on October 30th with The Risky World of Geopolitics, another top 10 issue. You may register at CRE.org. Until then, on behalf of the Councils of Real Estate, thank you for attending this session of What's Next for Real Estate and the Life Experience. Have a good day.